Okay, let me see if I can clear the water on this. I don't think I laid it out well enough, and also I don't think I gave you enough information. So let's start at the top. First of all, I've relabeled these. The number or the lettering was off. That had to be somewhat confusing. So the very first thing we have is cash dividends, and they're $8 or 8 cents per share. To calculate that, and this I didn't really give you, I guess I assumed you would figure it out, but bad on my part. We started with 375, but we had 25,000 as treasury stock that wasn't available. So we multiplied that times the 8 cents to come up with our dividend we paid last quarter, which has nothing to do with what the other things we're doing. But just to know that dividends do get paid at a later time than being declared. For B, we issued more common stock. Now, common stock has a par of $20, and we sold it for $24. So there's going to be excess um, of par on the common stock. I've given you the number for the common stock. You can multiply this out. The difference between the two becomes the excess. On C, we bought or we sold um, treasury stock. We sold this treasury stock. So I've given you the additional paid-in capital or excess because we have it at cost at 450, so I can only take 450 out. Now, if I multiply 25,000 times 26, it's going to come up to more than 450. It'll actually come up to $200,000 more than 450. So your cash is going to be different, but you can't remove more from an account that's already there, and we've only got $450,000 in there. So the next thing we look at is stock dividends. And stock dividends, I gave you a little box over here to help you with it. We had common stock of 375 and we issued 75,000 more, so we had 450,000 stocks available. We then have to multiply that 450 stocks times the 4% to come up with an 18% stock distribution, 18,000 stock distribution. And the market price of the stock at the time is what we're going to use to value this. So we'll take 18,000 times 25 and come up $450,000, which is somewhat confusing because we have this is stocks, the 450,000. This is dollars for the stock distribution. So that means that the stock was issued, the stock dividend was actually worth 450,000, but the distributable is only going to be for the $20 par. So it's going to be 18,000 times 20. And then there's going to be an excess of what the distributable is and the stock dividend. And that difference is what goes into the paid-in capital in excess. And actually, the next entry tells you what the stock dividend distributable is, because here you're paying it or distributing it. So to balance this out, this is going to be 360, which means the distributable was 360 up here. Treasury stock, this is a fairly straightforward entry. You're going to multiply 30,000 times the $19 you paid for it to come up with how much you have in treasury stock. Now the dividend was a little bit confusing, so I gave you some more information to the side. We began with 375. We added 75,000 in the new issue, and then we did the stock dividend of 18,000. So we add that all up, and you'll come to a grand total of 468,000 stocks. But you have to remember we bought back some treasury stock, so I have to subtract that. So that leaves me 438,000 stocks available for this dividend at 10 cents. If you multiply those out, you're going to come up with the stock dividend. And then I just ask you to close the income summary. So the income summary had a credit balance of 1,125,000, which I pretty well told you here you're going to debit it and credit retained earnings, and this actually is your net income, folks, that you're going to use in the next tab. And then we wanted to distribute. We want to get rid of our stocks. So if I add my stock dividends together with my regular dividends, I'm going to come up with 493,800. And when you get all done with this, your little red box should look just like this. It's just check numbers. Here's your number of shares that are outstanding right now. Here are the treasury stocks. You've got 30,000 treasury stocks. And there's, I'm not sure what the paid-in capital of 1,215,000 at this point. So now let's just fairly quickly look at this. These numbers right here, if you've done this correctly, should fill in from the other sheet. This is what they should be. So your numbers should match this. These numbers will end up here. This beginning retained earnings, you're going to find way back here, clear at the top, right here. So that becomes your beginning number. Goes right here. Then you're going to subtract your dividends and your stock dividends and get an increase in retained earnings and come up with an ending retained earnings, which is then going to be transferred over here. Now here's a again, these numbers should fill in automatically. But if you look at the should be, this is your retained earnings, and that could be a check figure for this. So this has a check figure in the next tab. So you can check that. So what do we do with this? So common stock, we move that over here. Additional paid-in capital, that will increase to 1,215,000, which was shown on the first page, right? And then we have our treasury sale, additional 200,000. And that would give us retained earnings. If you add this all up, it should match this. And then you want to deduct the treasury stock that's out, and I forget how much that was for. 570,000 it says here. So you should come up with a stockholders' equity of 44,436,200. These are all dollar amounts, so don't get them confused with um, quantities of stock. Now, we had to go through this whole thing so that you could understand where the numbers come from when you get to the retained earnings and the equity. So I hope this has helped level it out a bit so it makes more sense. Please email me with any questions, okay? Thank you.